Hi, this is Timothy Tom Koviak. I'm a licensed loan officer, and I'm authorized to get information you need. Thank you so much for watching and tuning in. Today on this video, I want to talk about a second mortgage, because right now in this market, I get a lot of questions about second mortgages, and I do a lot of them. Just to give you an example, I do 4 to 5 a month, and they're very, very popular right now. And there's a lot of confusion around them, and that's why I'm making this video, just to explain it to you. So what is a second mortgage? So you have your first mortgage, of course. A second mortgage is basically another way to tap into your equity. And there's two main products you can do to do this. One is called a HELOC. A HELOC stands for Home Equity Line of Credit. And that's basically what it is. It's a line of credit. Now, most people open them up for $50,000, and then when they close, they get about $50,000 or $25,000. We call that the initial draw. Now, you can open it up for any amount, based on what your home is worth. And I'll give you another example. Let's say you open it up for $90,000 and you take out $50,000. You get a payment based on the $50,000, not the full line of credit. And the best way I explain a HELOC is, think of it like a credit card. You open up a credit card, you have a line of credit, you pay on what you use, and you have a minimum payment. And the way the HELOC works is that you have a minimum payment of interest only. So that's kind of like a minimum payment with a credit card. So a minimum payment only, of interest only, and it's a revolving account. So that means you can pay off your HELOC and have no payment. And you can reuse it within a 10-year phase. So after 10 years of reusing your HELOC, it goes into something called prepayment phase, where basically you pay principal and interest required until it's paid off. And they don't come with any prepaid penalties. So you can be paid off, refinance, or sell. The other one is called a HE loan. Now, with the HE loan, it's a little bit different from the HELOC. The HE loan is just a regular loan. So you have your first mortgage and you take out a loan, and then you pay principal and interest. And then you can pick any term. They can do 5-year term, 10-year, 15, any term, 20-year term. And then you just pay principal interest with a fixed rate. Now remember, the HELOC, the home equity line of credit, is a variable rate and interest only payment. The HE loan is just a regular loan, principal and interest, a term. Now, let's talk about the benefits of a HELOC or a HE loan. The first benefit of them is that you don't have to refinance. Now, as you know, the last 2 years, interest rates were all-time low, historically low. So a lot of people refinanced in the last 2 years. And now they don't want to refinance again because interest rates are a lot higher than they are the last 2 years ago. But you still may need to do home improvements. You still may need to pay off debts. Your home may still be worth a lot of money. So that's a main benefit of a HELOC or HE loan, because you can still use your equity in your home, but you don't have to refinance your first mortgage. We'll leave your first mortgage alone. Another benefit of a HELOC and HE loan is you can borrow more. With a cash out refinance, you only can borrow up to 80% of what your home is worth. So with HE loans and HELOCs, you can borrow up to 95%. So you can leave very little equity in your home. And just note that if you do go up to 95%, the max, you do get a higher interest rate, because that's just a little more risky, because you're not leaving a lot of equity in your home. The more equity you leave in your home, the better. Another benefit of a HELOC is that there's no cost out of pocket. There's no appraisal. They're normally quicker than a refinance, and the cost is lower than a refinance. So what are the cons to a HELOC or HE loan? They come with a higher interest rate, because think about it this way. Your first mortgage, your first lien will always have a lower interest rate than the second lien. But the interest rate would be lower than any personal loan or any unsecured debt, any credit cards. It's still lower, but it's going to be higher rate than a first mortgage lien. Another con to home equity line of credits and HE loans is that they require higher credit. A second mortgage requires higher credit. And to give you an example, you want at least a 670, 680. and it requires a little bit higher debt to income. So you have to have lower debt to income. Lower debt to income. So a little bit harder to qualify. And then another con is that it's an additional payment. So you have your first mortgage and then your HELOC or HELOAN second mortgage payment. So those are the cons. But in some situations, it makes sense. If you're got a low 3% on your first mortgage, you may not want to refinance that. So it makes sense. But just keep in mind that it's going to be a little bit harder to qualify. So it's ideal for someone who has pretty good credit and not too much debt. If you have more questions, you're welcome to contact me. Leave me a comment. My links in below and connect with me. Thanks so much for watching. I'll see you on the next video.